This is why I think this shakeout has been so severe. I mean, I'm looking at what's happened in silver. I mean, silver is down nearly 7%. Platinum's down 5.7%. Palladium down 5.3%. And gold, as you said earlier, is 5%. I mean, given the rise that we've seen, this isn't actually all that great. I mean, you would just say this is volatility, if you like. I think basically, when you look at how much gold and silver and indeed platinum group metals have soared in recent months, some sort of correction was definitely on the cards. But the interesting thing is that the whole thing has really been a short squeeze. If you look on COMEX in particular, the speculators are just not there. I mean, they haven't really bought into it. The way I would measure that interest is looking at open interest. An open interest in gold is less than half the long-term average. Open interest in silver is roughly at the long-term average. I mean, there are obviously a few speculators in there, hedge funds, whatever, but not all that many. So this shakeout, it looks sort of suspiciously coordinated. I don't mean that, over the weekend, various bullion banks got together and had a meeting and decided to bash the market. But you do get this feeling, when you're a jobber. I mean, I've known jobbers, which is really what they do. I mean, the market maker is a jobber, basically. I've known these guys. I've been on the other side of them since 1970. And they do have this sense, if you like, in the market, when it's right to bash the price of something which they're short of. It's almost like a second sense. And if they haven't got it, they're not going to survive terribly long in whatever they're dealing in. So if one good dealer has got the feeling this is the moment when it's going to come off, the others also have the same feeling. So, you get this sort of compounding effect. And of course, I think what the buyers are doing in this, and remember, we're not talking retail market here, we're talking about wholesale market, and we're talking about big derivatives. The buyers, I think, they would just sit on their hands and watch this play out a bit before they decide, shall we buy some? And if so, what's a level? And so on and so forth. So, this is why I think this shakeout has been so severe. I mean, I'm looking at what's happened in silver. I mean, silver is down nearly 7%. Platinum's down 5.7%. Palladium down 5.3%. And gold, as you said earlier, is 5%. I mean, given the rise that we've seen, this isn't actually all that great. I mean, you would just say this is volatility, if you like.
Yeah, because people, of course, usually buy precious metals because they want more stability. The volatility is what you get at crypto, for example, but these are like crypto price swings that we're currently seeing in precious metals. So I think PR-wise for precious metals, it's not great to have insane swings, of course, but then again, when something goes up that fast, that much in a year, like gold and silver, then you have to have a correction at some point. And of course, the corrections are then more severe because of the high increase that went prior to that.
Yeah, no, you're absolutely right, Paul. And I've always told people, don't trade this market. I mean, you'd be nuts to trade it because the guys on the other end are so powerful. They'll take every cent you've got off you if you're going to trade it. And, the answer basically is that you've got to work out why you're interested in gold and silver. You've got to understand what gold and silver are. I mean, particularly gold in the current context, what it is. You've got to understand that it is legal money without counterparty risk. Forget what the US Treasury says about gold being a pet rock or whatever. The reality is that in our common law and in everyone's common law, gold is money, it's final settlement, there is no counterparty risk. And the volatility isn't so much in gold. I mean, obviously there's been volatility in gold, but it's mainly in the currencies. So when you see, for example, the People's Bank of China buying gold, the way to look at it is actually they're selling dollars. And they have other use for those funds. But basically, they don't want dollars. So that's, if you like, the sort of their gold purchases are almost the small change, which they haven't got any other use for, because they've got quite enough gold. I mean, not necessarily within their reserves, but the nation has lots of gold spread around various accounts, including the People's Liberation Army, the Communist Youth Wing, and so on and so on and so on. So that's the way to look at it. So you've got to think, okay, do I buy gold because I think that paper currencies are going to lose purchasing power? If you think that, then the answer is yes, and you hold it, you hoard it, you tuck it away. Otherwise, don't mess with it. Forget it. It's a waste. You'll just have sleepless nights if you try and trade it, because I can tell you, you try and trade this market, they will take you for every cent you've got. That's the reality of it.
Historically, major bullion banks and institutional dealers have demonstrated a remarkable instinct for timing. When they sense the price of a commodity rising beyond their comfort zone, they frequently act aggressively to push it lower. This isn't conspiracy-driven, it's survival. A few dominant players making the same decision at the same moment can rapidly trigger cascading sell-offs. Buyers in the wholesale market, meanwhile, often delay re-entering positions to observe how far prices will fall. The result? Sudden drops like the recent 5-7% declines across gold, silver, platinum, and palladium. Unsettling, yet common in highly leveraged environments.
I think there's another point which is worth making. We've seen various large American banks, turning bullish on gold. I mean, Jamie Dimon said he wouldn't be surprised if we went between 5,000 and 10,000. You had Morgan Stanley saying, you should put 20% of your portfolio into gold, which actually is an extraordinary statement from an establishment bank like that. I could imagine that Scott Bessent would sort of phone him up and say, "Why are you messing up my world?" But they've turned bullish, and from the point of view of market makers, the bullion banks who are trading, if you like, on the right side of the quote, this is not helpful to them at all to have this. So this is why, if someone told me that there was a coordinated move to basically bash gold and silver and also platinum group metals lower, I could believe it. I really could, because what they would want, it's not that they're anti-gold or silver, it's just they want to get their position square. And I think this is a desperate attempt to just do that. Let's try and, get our bears closed a bit, and then at least, we can trade it at a higher level. I think that's all. That's what's going on, if you like, in London and New York.
Despite turbulence, the long-term argument for precious metals remains rooted in trust. Gold represents money with no counterparty risk. Unlike fiat currencies, it requires no government or institution's promise to hold its value. Nations such as China have steadily exchanged their excess dollars for physical reserves, signaling declining confidence in the U.S. currency's global dominance. For individual investors, the logic is simple. If paper money continues losing purchasing power due to inflation, geopolitical uncertainty, or rising debt levels, gold becomes a safe haven, not a trading chip. Those who hold it aim for wealth preservation, not short-term profits.
Staying, if you like, with the market rather than the logic of buying or holding or hoarding gold or silver. You're absolutely right that you've got these logistical problems. I think the other thing which we will discover is whether on higher prices the shortage gets resolved. I suspect that people who have hoarded silver, I mean, let's just talk silver for the moment. It's true of gold as well. That's a slightly different situation. But people who have hoarded silver are either in two categories. They're either industrial users, and they're not going to sell their physical into the market, or they are investors. Now, there are various estimates out there as to how much silver is being held by investors. I've heard numbers of sort of 2 billion, 3 billion ounces. I don't know. I don't think it's nearly as much as that. I think all you can do is look at the stocks in COMEX and look at the stocks in London, and perhaps pencil in a figure for something in Switzerland. The rest of it, I think, we'd rather ignore, because the idea that you've got these investors, if you like, in places like China and all the rest of it, are likely to sell their stuff. I mean, if they sell it, it would probably, circulate within the country rather than come onto the general market. I think that these people are increasingly concerned that if they do sell their silver, they're not going to get it back. And the reason I think that they are feeling that is that if you have invested, hoarded silver, or indeed gold, and to a lesser extent platinum group metals, you are obviously taking a view that the purchasing power of the dollar or your own currency is declining. And we have seen enough evidence, I think, that this is now happening, perhaps at an accelerating rate. I mean, you don't need to be a sort of wonderful economist. You just have to have a look at, what Trump's doing, and you sort of think, this is capricious, it's destabilizing the whole thing. You see the geopolitical situation and so on and so forth. I think the answer is you hang on to your silver. I think that's what people will do. And I think that's what has really resulted in the squeeze in the market. I mean, if you look at the stocks, in the vaults in the LBMA, I can't remember exactly what the figures are, but, people try and make a guess about liquidity, and it's pretty minor. It really is. And of course, not only have you got the whole world, the retail world, I mean, all around the world, the story you were telling, I heard from Australia this morning. I've heard also in America, UK, everywhere.
Everywhere, yeah.
Everywhere. Everybody's run out of silver and gold coin and bars. The Perth Mint has stopped. It's got no silver, no gold, and so on. So this is a global story, if you like. And under those circumstances, you sort of think, well, if I am going to sell my silver, do I sell it while there is this shortage? I think I'd probably ride it out a bit more. That is if you're even trading it. If, on the other hand, you're a hoarder and you're sort of looking at what's going on in the world and all the rest of it, then you probably think, well, wasn't I clever buying it? I'm just going to sit on it. So You have this situation where there's something called a Giffen good. The more it rises, the more demand it creates, and the lower the supply becomes. In other words, it's a complete reverse, if you like, of market theory that rising prices will, release more product. Now, having said that, I mean, you've also got other factors coming in. I mean, there is no doubt that the mines are becoming very profitable on these prices. You must be coining it in, and if it goes up further, even more so. But what does a mine manager do? And I think this is a point which many of the sort of commentators don't really understand. A mine manager's job, basically, is to maximize his cash flow in the context of the business he's running. So when he sees the price rise, what he does is he mines the lower grades. So does this lead to more supply? Not really. And the other thing is that something, I think over 50% of silver mine supply comes out as a byproduct of the mining of other metals. So, that's something. Scrap takes a bit of time to, it doesn't take terribly long to turn it, but it's a question of refining capacity. And at the moment, refiners, they're not really interested in taking in silver because they're so busy with gold. So, there are a number of factors which I think lead to the squeeze. And, anybody who owns silver, I think, when they reflect upon it, they sort of think, well, wasn't I right to buy it? And I think that's the way it is. And with gold, there's something interesting there too, because we don't have the backwardations between the spot and the futures market. Seems to be quite normal. I think that the bullion banks are trading that. reasonably successfully. I think they probably welcome the uptick in business. They will be losing a bit on their positions on a mark-to-market basis, but they will be making lots and lots of money dealing, I think. But the problem I think the gold market has is that following the fiasco earlier this year, whereby the Bank of England was exporting gold out of its vault as quickly as it could, I think the central bank customers, because it's mainly central bank gold going out on lease, I think they would probably question the wisdom of leasing, because in the past it was leased and it would sit in the Bank of England's vault. Okay, it goes round and round and round, being hypothecated, rehypothecated, rehypothecated, and all the rest of it. But at least it was in the vault, and you knew it wasn't going to go anywhere by the end of the lease. Now it's gone. It's gone. So where's it gone? Am I going to get my gold back?
Yeah,
I think this means that central banks would be withdrawing from the leasing game, and that I think is where the squeeze comes in gold. We don't see it in prices yet, but I think that's probably why the price is rising. I'm looking at it just purely in market terms. This is why the price is rising. It's been rising so steeply because the system knows that it doesn't have the supply of physical, which has come through leasing, if you like. I mean, the lease rates haven't jumped or anything like that. It's just that, we know that we've got to get this price up in order. I mean, this is a sort of collective, if you like, view. We've got to get the price up simply because of the lack of leasing coming on. I mean, what's leased is leased at the moment, but leases aren't necessarily going to be renewed. So that does mean that there's going to be tightness in the market. And consequently, these prices are going up. And I think that's the way the market makers look at it, in fact. And I look at it in economic terms, which and I can tell you that people in the market just don't understand economics. They don't understand the economic thing at all. They just got sort of vague thing that, when people get worried about things, they buy gold.
Silver's market dynamics are more fragile than gold's. Only a minority of global supply comes from primary silver mines. Over 50% emerges as a byproduct from mining other metals like copper and zinc. Even if prices rise, miners prioritize efficiency over maximum output, limiting new supply. Meanwhile, physical retailers across Australia, Europe, and the United States report widespread shortages of coins and bars. Investors who hold silver increasingly view it as irreplaceable. Once sold, it may be impossible to reacquire at the same price. Rising prices ironically reduce circulation, creating a self-reinforcing cycle of higher demand and lower availability.
I mean, this is what central banks are doing. I'm not talking about your central bank, our central bank in Britain. I mean, they'd rather not discuss the subject. But I think the central bank community, particularly in the global south, BRICS and so on and so forth, they can see what China is doing. With the SGE opening vaults in Hong Kong and also Saudi Arabia, and there are probably plans for other ones, or certainly facilities elsewhere, whereby gold can be exchanged for yuan. This is setting up a system which will allow the Chinese, if it is necessary, to protect the yuan's value by turning it into a gold substitute. But that will be at the international trade level. The idea that individuals in China would be allowed to, have a gold exchange, if you like, for their yuan. I mean, I don't see that at all. The authorities in China, I think, are all about hanging on to what they've got. They don't really want to part with it. And I think it would be a mistake to sort of think that, the Chinese authorities, whether we're talking about PBOC's reserves or whether we're talking about the hidden holdings, sort of spread around the various communist organizations, government organizations, I don't really see that they will be feeding this new vaulting system outside China. I think they're going to still hang on to their gold. But I think what they will do is they'll say, well, what you could do is you could acquire some gold, put it in that vault. You could exchange it for yuan when it comes to trade settling and all the rest of it, so that you foreign country have the facility to trade in a gold-backed yuan. They will set the rate at some stage. I think that's inevitably what's going to happen. And it doesn't really require China to part with some of its gold. Maybe a small amount, but basically, I think the idea is to make the yuan, if you like, the dollar's replacement. And this one will be a lot more secure than the dollar. I think that's the important thing. And as the dollar declines, we're coming to, there's no doubt in my mind that we're coming to the end of the fiat currency system. The Chinese, I think, are perfectly aware of this. And they want to protect their currency. They want to protect, their position. And they don't want other currencies, for goodness sake. If the dollar goes down, what happens to the other currencies? They go with it. It's as simple as that. So they will want to trade in their own currency. Of that, I'm absolutely convinced. And they will want to protect the value of their currency. So we can see this is beginning to happen. Now, I think the central banks around the world can see it. I think governments are beginning to see it. I think some of the really big players, like ultra high net worth individuals, the sort of really wealthy families around Asia, who liaise with politicians, who have them round to dinner, and all the rest of it. I think this is the back chat that goes on with these meetings. They know about it. I think that some of the smarter hedge fund managers in the US probably know a little bit about it or suspect it. The rest of the investment world has not got a clue. But you'll find that the information filters down. It'll filter down gradually as, events unfold. And there will be if you like, a growing understanding actually about what actually is happening. And we're looking at the end of the fiat dollar. I think this is really what it's all about.
Central banks in emerging economies, especially China and BRICS-aligned nations, are quietly shifting away from US dollar dependence. China has opened new gold vaults in Hong Kong, Saudi Arabia, and other strategic locations, enabling more trade to be settled in yuan backed by gold reserves. Unlike the historic Bretton Woods system, this evolving framework doesn't require nations to hand their gold to the US. Instead, it empowers countries to store value independently while conducting international trade. As leasing arrangements shrink and physical supply tightens, global pricing increasingly reflects genuine demand rather than financial engineering.
I think that's a good way to describe it, Paul, because, the thing about Bretton Woods is that it was this sort of high-level, you can't exchange your currency for gold, but this is a system which basically everybody who's in Bretton Woods, we're in there at a fixed rate, and gold basically is the tie for all the fixed rates. And that was fine, so long as the Americans, who had the bulk of the gold, certainly in the late 1940s, that was fine until the Americans began to run out of gold, and then you had the end of Bretton Woods. And Zoltan Pozsar, I don't know, you remember him? He was Credit Suisse. He described the current situation as Bretton Woods 2, and which is not the rather clumsy way of putting it, because it's not a Bretton Woods system in any way. So you had the Bretton Woods system, you had the fiat currency system, and he was raising a question mark: are we going into Bretton Woods 3?
Right. Yeah.
In other words, is this the end of the fiat currency system, and it's going to be replaced by something else? That was the question he raised. And he was raising this question, 3 or 4 years ago? And I think the thing that's really done it was COVID, when the economy shut down. There was an explosion in government debt as a result. And it's clear to me that large parts of our economies haven't recovered from that at all. You've got some zombie companies who took on debt basically because they ceased trading for however many months. They took on debt and they've never really got rid of it. And the problem is that interest rates have gone up. They can't afford current interest rates. And of course, this has led to other distortions. For example, you've got the shadow banking system, so-called, in America. In this case, we're looking at private equity and hedge funds who use their if you like, their rating in order to borrow from the banks to lend on to those who basically the banks won't lend to. Why won't the banks lend? I mean, the banks aren't stupid. They won't lend to these companies because they're zombies. So the zombies are getting sort of payday loans out of the shadow banking system. And that's a big accident waiting to happen. It really is. I mean, and this is what Jamie Dimon referring to the other day. He's talking about cockroaches. You see one, they're going to be more.
The pandemic triggered massive debt creation, corporate instability, and the rise of so-called zombie companies surviving only through borrowed lifelines. Meanwhile, the shadow banking sector, private equity and hedge funds, extends risky loans where traditional banks refuse. Major financial leaders warn of hidden vulnerabilities beneath the surface. Combined with geopolitical fractures and inflation, many analysts believe we may be approaching the final stage of the current fiat currency era. As trust in paper money erodes, precious metals appear not as relics, but as anchors of economic certainty. Those who anticipated this shift are simply holding tight and waiting.